Well, Kyle, thank you for coming in to talk with Danny and I about what's going on in the insurance world right now. We do these video blogs periodically and send them out to our marketplace of self-storage owners and investors throughout Texas, primarily Texas, but the greater Southwest in general. And one of the things that we like to try to do is keep our owners and operators, developers, investors who are looking to get into the industry for the first time, perhaps, keep them updated with what's going on in the marketplace. One of the things we're going through right now is just to see how high insurance premiums have become, and we're not even sure we understand the dynamics of why that's happening. We just know that it is, and we as brokers focusing explicitly on self-storage transactions throughout the Southwest and primarily in Texas, it would behoove us to understand in more detail why this is happening, what owners can do about it, what should they expect moving forward, how can they prepare for what's coming. And so that's the reason why we've invited you here. Thank you for joining us. And we just like to allow you to have the opportunity to tell our marketplace who you are with, what you do, how you do it, how long you've been doing it, and we can perhaps get into a discussion about self-storage in particular, a little bit more detail.
Yeah. Well, thanks for having me, guys.
Sure.
Name's Kyle Cardwell with Swingle Collins Associates in Dallas, Texas. We're a top 100 independent insurance agency. Been around for 41 years, and our big focus is commercial real estate. We insure billions of dollars of properties, all asset classes, all around the country. A lot of that is self-storage, and insurance hasn't been that interesting in self-storage until the last 3 years, and now all of a sudden we're a hot topic. And it's a lot of the strategies we use on industrial properties and office portfolios we're now having to bring into self-storage just to try and help owners cut cost and save money where they can to fight the increases that we're seeing.
So what if you had a big overall blanket statement that we'll try to drill down into in a minute? What is the status of the insurance market? Is this unique to Texas? Is this a national thing? We're hearing also, I mean, at the end of the day, Danny and I are just having conversations with owners where we, to your point, we've never really had to dig into this particular topic before in our 13-year history of doing this for a living. And now we do. And so having a macro level perspective of what's happening would be certainly very advantageous. What's your take on why we are having this conversation to begin with?
Yeah, well, it's a global insurance market that's affecting people who own a $5 million property in Texas, and they're at the whims of the total insurance market. And so what we typically see is cycles, like from 2013, 2019, the market was soft, and so rates were going down every year. And then 2020, and should have been 21, 22, rates should have been going up. But with the new market, everything's different. It's a global shift in rates. It's a market adjustment. It's not just we're going up 10%. Is you may go up 50% or 300%,
Right.
depending where you are. Texas is affected. Florida is more affected than Texas. California is more affected than Texas. But we're probably the third worst state as far as state of Texas to do insurance in.
Is that a byproduct of coastline and the propensity for big weather events that might take California and Florida to that, and then obviously Texas with the Gulf of Mexico? And is that the reason for?
Yeah. So Florida is bad because they have let lawyers into their insurance market. So one, they get hit by a lot of hurricanes, but they also have built buildings to sustain hurricanes, and so they have a lot of property at risk, but they also can protect their properties better than a warehouse in Central Texas. The roof will fly off if a tornado flies by. Their buildings can take it. Florida has 8% of the claims in the country and 54% of the litigation. And so those lawyers in the system just drive up the cost on top of the weather events. And then California, their problem is they have an elected insurance official whose job is to basically get reelected. And so he came across and said, we're only going to allow insurance carriers to raise rates 6%. But they have wildfires, haven't had an earthquake in a while. They also have storms. They have all the other bad events that everyone else has, but the insurance carriers aren't allowed to raise their rates fast enough to make up for their losses, so they're just leaving the state entirely. In Texas, and insurance is a great market. It's a pure free market. If someone is making a profit,
Except if you're in California.
yes.
Yeah.
And so in Texas, if someone is making a profit, there's 5 other carriers to come undercut them. And the insurance carrier's goal is for every $100 of premium they get in to pay out $70 in claims, have $30 to cover expenses, and then they make the profit on investing that $100 while they hold it. And that's how the insurance market works. So if someone is making profit on that $100 they took in, 5 other carriers will come in like, well, I'll do it for $95. I'll do it for $90. And this is how you get the rates soft.
Sure.
Now the downside is, and it was hard for the self-storage owners, the carriers are going from 100 to 110 and they're still losing money. And so now they're going to 120 and still losing money. And that's where we're seeing this year-over-year increase of rates and costs for owners. And you're thinking, okay, I paid, $30,000 last year, now I'm paying $45,000 of premium this year. I didn't have any claims. Why does the carrier want to go to $60,000? It's because the carrier didn't lose money on your property, they lost money globally. And so now they're raising rates on everybody.
If we think about interest rates, right, we look at interest rates right now as if they've gone up tremendously, but really the past 10 years or so, the really egregiously low rate, that's the anomaly,
Yeah.
right? Where we are now is much more normal within a bigger horizon. How much was that soft market representative of a larger conversation, and versus like how unique was it, and how unique is this compared to what's occurred over 40 years or 30 years?
Yeah, good question. So the soft market 13-19 was a very normal market, and it was, and coming out of 08, 09 and that kind of quick recession, the rates went up a lot in 8, 9, and 10, kind of flattened at 11, 12, and then we started to see the normal soft. So it was a normal up market, normal soft market. What we're seeing right now, and last year and the year before, and then for the next coming years, is more like the 1980s. And this is a market shift in how insurance is handled, how it's priced, and it's drastically affecting everything, every model, because of inflation, because of interest rates, because of supply chain, and because of weather events.
Global
and
weather
claims.
event, right.
Everything is different now than it has been. So insurance carriers look at past trends, and that's how they decide how to price things in the future. And what we're seeing is things are completely different. And so they're trying to guess the future based on new information. So for example, the insurance market looks at billion-dollar weather events in North America. And so from 1980 until 2017, we averaged $8 billion weather events a year. And that was pretty typical. Some years there's 5, some years there's 11.
Total cost of all of the weather events was approximately $8 billion, or
They're $1 billion weather
$1 billion. Okay, got it.
And there was a lot more claims than that, but they look at
The big ones.
the big catastrophe cat events.
Right.
There were $8 billion events on average for that 30 years. Then from 2017 through 2022, over 5 years, we went from 8 events a year to 18 events a year. And so, 200% more weather events that they're having to price for. Just so far in 2023, from January 1st to October 1st, we've had $23 billion events. So this year is worse than the last 5 years, which was more than double the previous 30 years. And its weather is worse, and that worse weather is causing more claims, which causes the carriers to pay out more, which charges them to charge more to people.
Do you anticipate, does this feel like it's just going to be the new normal, and we got to assume that that's the case? I don't want you to predict the weather.
Yeah.
It's obviously a difficult thing to do, but you understand what I'm asking.
So what we're seeing is it used to be that if you owned a property in Arizona, which is the safest place to do insurance, nothing bad happens in Arizona, so they don't charge any premium. But if you had a property in Arizona and a property in Dallas and property in Houston and property in Florida, they were all priced within 50% of each other. And now we're seeing the market dynamics change, that a property in North Texas, the insurance will be 4 times as much as the insurance in Arizona. A property in Florida will be 10 to 20 times as much as Arizona. And so the market is pricing each area based on its unique risk, not looking at North America as a total. And so this may be hard to do through a video, but if you have a 50,000 square foot property, the replacement cost to rebuild it used to be $30 a foot. It used to be $25 a foot, went to $30 and $35 a foot. And so that is the cost, not the cement, but the cost to do the walls and rebuild the building if it get wiped off the face of the earth in a tornado. And because of inflation, what we're seeing is that's going from $30 a foot to $60 a foot. So just based on your premium, if the rate stayed the same, just on that, your premium doubled, just because of the increase in cost of material to rebuild a property. And then what we're seeing with these claims frequency and the claims severity is the carriers have to charge more. So, okay, now I have to build something that costs twice as much as it used to, but now I have to charge for the frequency, severity of these claims. So the rates went from about 30 cents to 60 cents. And so where a 50,000 square foot property in 2017, 2018, maybe cost $5,000 of property insurance premium, now that same property is $15,000. And so if you weren't ready for that increase, that blows your budget in insurance and changes how you want to look at buying a property, underwriting it. Then if you go down to Harris County is unique because insurance carriers do something called reinsurance. They go up and they buy reinsurance from other carriers. So if you're on the coast in Harris County, or if you're up close to the Woodlands, it's all Harris County. And so the number of carriers who will do that lessens. So people ask me, so my insurance is cheaper because I'm in Montgomery County than Harris County, even though they're a mile apart? I'm like, yes, because the number of options who will insure you is twice as many. So you have more competition, which will drive down your insurance cost. So when people are looking up in that spring kind of Woodlands area, it matters if you're in Harris County or Montgomery County and when you're buying properties. And then if you're right on the coast, if you're on Galveston Island, there's the TWIA, the wind insurance pool. That's
Right.
actually less than buying in the normal market. And so there's this short time period where you may do better selling or buying something or insuring something on Galveston Island than something 5 miles inland. And that 5 miles inland is going to be expensive, but if you go to Montgomery County, then it's cheaper than that. And so it's just this weird dynamic right now. But if you're in Harris County, I know this doesn't mean anything to people that don't deal with insurance, but the rates in Dallas are about 50 cents for a self-storage. Something in Spring or northern Harris County, it's like 80 cents. And if you get down, if you're not able to do the wind pool, but you're down close to the coast near the ship channel, you may be $1, $1.25. And so just a percentage wise, if you're in Harris County, you may be paying twice as much as North Texas for insurance right now.
How does the sales price impact a new borrower's insurance if they're buying it at a level that's, like Brandon said, significantly above the replacement cost?
Yeah, good question. So in insurance world, we don't know about the sales price, the tax value, and the replacement cost value that insurance people do. Totally irrelevant, because your sales price also includes the land value and then the cash flow, which is really the most important thing in
Right.
sales price.
Right.
Insurance is only about rebuilding the building. And so
There we go.
It's
There we
about,
go.
And so if someone takes the amount of square footage they have times $60,
Right.
that's about the insurance value. And it is totally irrelevant if that's what you can sell it for.
Interesting.
But what we're seeing now with the interest rates being up is people are selling properties and buying properties for less than they were because of that interest rate squeeze. And so someone's like, I'm buying a property for $2 million. I don't want to insure it for $3 million. Or I'm paying tax on $2 million. I don't want to insure it for $3 million. And it's like, it doesn't matter to us what you buy it for or what your tax is. We got to insure for what it costs to rebuild it. And that's the insurance carriers. There's a calculator that Marshall Swift that all the insurance carriers use, and that's what tells them the value to charge. So every carrier uses the same calculator, and it's based on the type of building you are, if it's a office building or if it's a self-storage, if it's where it is, what zip code for material cost and labor cost, how many stories it is, and then it tells the carrier how much to charge. And so they all use the same calculation. So you won't get one carrier that's like, I'm going to insure your building for $100 a foot, and one's like, I'm going to do it for $20. They're all usually within 5% of each other.
Well, who's this Marshall Swift?
Yeah.
And how can we get a hold of them? That seems like the question for us is, if it's that consistent across the board, how does one make a decision in terms of who they want their carrier to be, who do they want their broker to be? How can somebody in your position add value to the strategic decision-making process that an owner would have if in reality they're all going to go back and say, we're using the Marshall Swift calculator, we're within 5%. There's not a tremendous amount of opportunity for me to move the needle one way or the other.
Yeah.
That would be my question if I was in that position.
Yeah, good question. So a lot of times the industry treats us like bankers, where I need to go call bank A, B, and C, and they're all going to present their loan option. And we're not bankers. We're negotiators just like you guys. So we represent people in the marketplace. So you don't go pick 3 lawyers to go negotiate your lease or 3 CPAs to negotiate your taxes. You pick one. And insurance should be the same way. You should pick one agent to represent you in the market. Because in self-storage, there's only about 5 carriers to go to.
Is that lower than it used to be a year ago, year and a
Yes.
half ago? That's
Yeah.
what I thought,
Yeah,
right?
10 years ago, it used to be 20.
Wow.
And now we're down to 5. And those 5, what happens because the insurance is terrible is every owner is saying, agent, please go get me 5 options. Go get me multiple options. So these underwriters that work at the carriers, and people forget that underwriters are real people. You know, you just send it off to your agent, then you get quotes back. You forget that there's people that get your application that spend 4 to 12 hours working up a quote to send it back to you. So these underwriters that are inundated with applications, they'll get 100 applications in a week, but they're only going to bind 5. And so they have to decide, of these 100, what do I work on? And which 5 am I actually going to win? And so that comes to where who's your agent? And so the fact that we do a lot of self-storage, when I call up Casey or Aaron, they know who I am. They know when I'm presenting something that I know what I'm talking about. I'll tell them the situation. I'm telling what they need to do to win a deal. And so owners need to pick the right agent. And if it's someone who just casually does self-storage, they don't know the market and they don't know the players. But there's a couple agencies like Swingle Collins that specialize in it, and you want to get with one of them, you'll get a better result out of the same carriers than if you go with somebody else.
So we deal with on a daily basis single mom and pop owner operators all the way up to the REITs and everyone in between. So what can our clients do to kind of put themselves in a better position when that renewal is coming due?
Yep. So the biggest question in Texas right now is your roof age. And so if you have an older roof, 10 years or older, so what's happening and what's new in the last couple of years is it used to be if you had a 30-year-old roof and you had an insurance policy and it got hailed on, the insurance carrier would give you a brand new roof. So like every Texan, I'm like, I need a new roof. When's
Sure.
the next hailstorm?
Sure.
And you're just waiting for it. Well, the insurance industry's tired of paying out all those claims. And so what they're doing is if you have a 10-year-old roof, a 12-year-old, 15-year-old roof, then they're going to take you from replacement cost to depreciated value, then apply your deductible. And so for a lot of times that goes from someone, if you have a $500,000 roof and getting $500,000 less your $100,000 deductible, now you're going to have a $500,000 roof and get $50,000 or $75,000 for that roof. So the best thing owners can do is budget and plan on replacing their roof themselves if there's not an insurance claim around it, or you're paying about the same premium. It's not like I was paying $50,000 premium and I'm paying $10 for this depreciated roof. You're paying $50, now you're paying $49 for almost no coverage. So if I was an owner, I would look at investing in new roofs, and that's the biggest question underwriters look at. It's hard if you're a single location owner. If you have other asset types, we can actually look at combining the self-storage with the 3
Right.
warehouses or the shopping center. And so we didn't used to do that before, but now we can look at how many other assets can we add this with, even if they're not self-storage. And so biggest thing would be roof. Other things is what can we combine with on that side. And a lot of it's just planning. We're giving a lot of bad news. And so what we'll try and do is go to owners 90 days ahead of time and say, your insurance is going to go up 50 to 100%. Now here's the 10 things I'm going to do to try and make it only go up 50%, but it could be as bad as 100. And give them a quarter to get ready for that. And they can spend capital differently. They can change rates on customers differently, but they can be ready for it. The worst case scenario is your agent is scared of you and comes up the day before and says, hey, your insurance doubled. And then you're stuck and you have to buy that rate because your lender is going to make you get it, or they're going to force place the insurance at 3 times this cost. And so what we're seeing is a lot of owners call us mad the day after renewal because they didn't know it was coming. Versus what we try and do is educate people. This is coming, prepare for it, and there's nothing you can do about it.
Well, rest assured, part of the reason why when we were thinking about having this conversation and when we called you to come in to talk about it is because we know that at a philosophical level, you have indeed approached your business much in the same way that Danny and I approach ours, which is to say that we are really advisory focused at our core, right, as opposed to transactional focused. And so the idea that you are reaching out to your clients a quarter, 3 months before, 4 months before all of this comes to a head is something that resonates with us because we try to do the exact same thing when it comes to advising owners of what we think is the appropriate strategy moving forward. I suspect that that's not how everybody works in your business, similar to kind of the way our business is. Is that accurate to say that that's somewhat unique?
Yeah, I would say the average insurance agent's pretty average, and they're surprising people with increases instead of educating. And a lot of times it's because they're selling insurance, they're transactional, versus where we are in our world, we're buying insurance for people, and so we're educating them and helping. If you knew everything I knew, this is what I would do. And it gets more fun if you have big owners, someone with 10, 20, 30, 50 properties. That's where there's a lot of strategies that we can employ to help lower the cost. So if you have, if you have 10 $5 million properties, so you're buying $50 million of insurance, but you're not going to lose all 10 properties in one storm. Well, let's go back and buy $5 million of insurance or $7.5 million of insurance to cover if 1 or 2 properties gets wiped off the face of the earth in one storm. And that's where we can start seeing some savings. A lot of stuff what we're doing now is also negotiating with lenders. Is you signed up a loan that said I was going to insure my property at full replacement cost. And now we're going back to lenders saying it's not available. It's physically not available in the marketplace. I have a property in downtown Dallas that's worth $120 million. And last year we bought $120 million of insurance. But because of claims in the asset class, we were only buying $10 million of insurance this year. And it was 250% more expensive than last year. So we have to go to the lender and say, if you want me to fully insure it, I won't have any money left over to pay my mortgage. And so the lenders are deviating and they're changing and they're looking the other way because they understand the marketplace. And you're not the only person going to your lender saying, I have this problem. They're hearing it from everybody. And depending who the lender is, some are very willing to work with you and some are not. And it gets awkward.
To what extent does your willingness to look at other property types and combine them with self-storage, if that owner has multiple asset classes, to what extent does that represent some kind of conceptual pivot that you guys have made recently in order to deal with this changing landscape? Or is that something that's been there forever?
It's always been there, but it hasn't been the best option. So Minico is the original insurance carrier for self-storages, and they have stopped writing wind coverage in Texas. And so they're no longer an option for us. And other niche carriers that did self-storages specialized in self-storages, and they were writing those at a different rate than the other asset classes. But now we're looking at these big national programs that they insure office buildings and warehouses and retail spaces already. So just adding in a self-storage into what they do is normal compared to a Minico would not want your shopping center. They would say no to that because they specialize. And what happened, Minico buys reinsurance. And so they went to the reinsurance carrier and said, I'm only going to write in this box. And those carriers that specialized in the self-storage box have lost so much money, they're not even around anymore. Minico's around, but just not writing in Texas. Other programs just don't write in Texas or along the Gulf Coast. And so the carriers that we're able to assign other asset classes to have always been around, but now it's just an option because that's how poorly things are priced that we're now back up to them to work with. But once self-storages start making money in insurance, you'll start seeing the niche players come back in and start saying, okay, I'll do self-storage for 25% less than that warehouse, and they'll start pricing things down again.
So one thing that we hear pretty often from a buyer is, hey, Danny, I'm going to be buying this property at $80, $100, $150 per rentable square foot. So I'm assuming that my insurance is going to go up to that value. Now, is that the case, or is insurance just more based on a kind of replacement cost in your experience?
Yeah, so the value you're buying it for and the tax value and the insurance value are three totally different things. And so what you're paying for the property has no variance on what we insure it for. And the insurance is based on the replacement cost, based on a calculator that all the carriers use. And that how much you are how much you're paying for a property high, or if you're buying a property very inexpensively, the insurance is going to cost what the insurance cost.
Okay, that makes sense. So let's start from a kind of macro level view. What is the big driver behind these just egregious increases in insurance? Is it global events? Is it weather related? Is it geography? Is it COVID? What's causing all this pain for our clients?
Yeah, all of it. There's a couple factors that go into insurance pricing, and they're all negative right now. So high interest rates are bad because capital leaves the insurance market and chases the high interest rates in something safe like bonds or mortgages. And so interest rates are bad for insurance. Inflationary costs. So a building, if you had a fire in a building, it used to cost $100,000 fix. Now, because of material costs and labor, now it's $200,000 a fix. So the frequency claims now cost more on that side. We're seeing reinsurance. So the big money, the global investment funds that come into insurance that invest $500 million or $1 billion in insurance, they're losing money because of the amount of claims that are happening. And so they're pulling capital out and going to invest other places. And so the supply of insurance is down because the premiums are up. Insurance carriers are just like banks, so they can only insure based on the amount of assets they have. And insurance carriers are really risk averse, so they invested their assets in really safe, stable investments, but the premiums are going up because now properties are worth more. So, someone could only insure $1 billion of real estate and they had $800 million out. Well, now that $800 million of property is now worth $1 billion. And so they're running out of capacity to even insure. They're running out of, and I have a client now, we have a 1 million square foot warehouse in Fort Worth that the primary carrier is insuring $25 million of loss, and now they're going down to $5 million. And they said, we just ran out of capacity in North Texas, so we're going to insure you for less. So, and then weather is terrible. Weather, the frequency events, the severity events, both are up. And so we're seeing that just the amount of claims, so the insurance carriers are paying out so much more than the premium they're taking in. They're having to raise rates on people and raise the amount of premium they take in. They'll still lose money and they have to raise it again. And 2023 was terrible compared to 2022. 2022 was terrible compared to 21. 24, we should get back to a normal increase. Well, prices will go up 10 to 25%, not triple. And so we should see hopefully a top of the market where 2025, hopefully we start going down the other way. Because what happens once the premiums are up so high and the insurance industry collects more money than it pays out, capital will chase that profit into the market, and that's where soft rates start coming in and prices start going down.
Okay, so there's some silver lining. That's the good news.
Yes, eventually you pay so much that other people want to take your money, and that's where the good news is.
Right.
So when we're evaluating a self-storage facility's potential value in today's marketplace, often we're looking at it from a purely financial aspect, and we have to make adjustments to the expense load to take into account what a new owner might do differently. And one of those things that we used to not have to worry about very often was obviously insurance. So if you were in our shoes, how would you assume insurance costs would increase for a new owner?
Yeah, so if I was going to buy a property, only thinking about I want to buy the best property for insurance, not any other factor, I would want to do it in Central Texas, Austin, San Antonio area, not North Texas or the coast. I would want a multi-story climate controlled building because if you have a 100,000 square foot 3-story building, now that has a 33,000 square foot roof versus 100,000 square feet 10 building 1-stories, they have 100,000 square foot roof. So the risk for the insurance paying a claim's a lot less in that multi-story building. I'd want something built in the last 10 years and with a roof that's 10 years or younger. But the roof age now really matters to insurance. And so if I was selling a property, I would think about I may get more for my property if I'm going to put a new roof on voluntarily a year before I sell it versus try and sell property with an old roof. And if you have a 1960s, 70s, 80s property with a 20-year-old roof, that roof is uninsurable. You're able to insure it as the seller because that carrier's been on it so long. But from a buyer standpoint, what carrier is going to want to insure essentially a $300,000 risk that they're only going to collect $10 or $20 or $30,000 the first year? And so the carriers are just saying no. They have options when they get so many applications in a month. If I can only insure 5 properties this month, I'm going to go pick the 2015, 2020 build with a new roof, not the 1960 property with a 30-year-old roof.
Sure.
And
Kyle, so you had mentioned earlier some of the different types of properties where in an ideal scenario you'd want something in Central Texas that it's climate controlled, it's second story, et cetera. Let's say I have none of that,
Yep.
right? And in those circumstances, you said the roof's uninsurable. It could be. Well, the vast majority of the deals that we do will indeed fall into the category that you're saying, none of that, it might be uninsurable. How would you advise Danny and I to go about having a conversation with our clients if indeed they own a 40,000 square foot property that's non-climate controlled and built in 1985, if the market is as difficult and as hard to negotiate as it clearly is?
yeah. And so what we do as agents is we try and sell the story to the underwriter. So the question would be, what are the updates? Is this a building that hasn't been touched for 40, 50 years? Or is someone living on this building? Are they spending money on it? So what I'd want to know as the agent of the buyer looking at this property is, what capital improvements have you done over the years? Tell me how much money you've spent redoing the parking lot, redoing the driveway, putting in fencing, putting in security cameras, fixing leaks in the roof. It's an old roof, but it's been cared for. And so though I wanted to have to be able to go tell this story to the underwriter on why this is a 1960s building, but this is the one you should insure, not another one. And so as much data as you guys get us, which you're great at, helps us sell it to the underwriter on why this property is worthy of insuring versus another one that's just a ticking time bomb of an insurance claim.
So it's safe to assume, though, that we can't, given the nature of the marketplace, we're never really going to be able to go and put our a new buyer or an existing seller in a position where we've gotten a hard and fast quote, right? Your carriers have got 100 deals, they pick 5. We can't assume that we're going to get an actual quote back from them. We need to rely on your counsel to understand what is generally going to be doable and isn't doable. Is that fair to say?
Yeah, so we see enough deals that if you give me a property, just the offering memorandum, I can tell you what the insurance will cost, irregardless of what the seller's paying. The seller may be paying what I think the buyer's going to pay, or the seller could be paying half.
Right.
But I can give you a ballpark on what the buyer should expect to pay for that property.
Okay, great. Can you give us an example or more, or at least one that comes to mind of some deal that you've done recently where you and Swingle Collins in particular took your experience, expertise, and knowledge of the market to really help a client in a particular situation that seemed like it was going to be a real difficult task? Is there an example that you can tell us about how you've helped that buyer in the past?
Yeah.
Seller.
So the way the insurance industry works is every agent uses a company called Accord to fill an application, so that's what the underwriters get. And kind of like if you've heard about the home buying market is really tight in certain areas, and the buyers are making their offer and they're also writing a letter about how they should be picked to be the buyer for that house versus somebody else. We are now having to write up selling stories. So I have a property over in Fort Worth. They've spent a lot of capital improvements on it. We sent paid receipts to not just, hey, we spent a lot of money on this property. We sent the paid receipts to the underwriter on this is what we spent money on, this is what we did, this is the updates we did, and sold that properties in Fort Worth get more hail than properties in Garland and Mesquite. But this is the property you should do.
To what extent will the marketplace, insurance marketplace, treat the same a totally new roof versus one of those new TPO covers that you can that you can put on it? What would be any, if any, are the differences in the way the marketplace would look at it?
Yeah, just solely from an insurance perspective, the TPO roof is not the same as a roof replacement. So what we're seeing on the insurance policies is they say that we want this building to have a brand new roof, and if it's over 10 years old, then you're going to get depreciated value. You're basically going to get 75% of the value of the roof that a 9-year-old roof would get if it's 11 years old. So a lot of times when people do have hail claims, they'll put the white TPO roof on, and they consider that being a new roof. The insurance industry does not. They look at that as a roof repair. And so if you buy a property with a TPO roof that was put on 3 years ago on a 15-year-old sub roof, and when another claim happens, the insurance carrier will try and pay out a depreciated value versus the replacement cost. And so there's no, it's good, it keeps the water out, it prolongs the life of the old roof, but with this new endorsement in insurance that's bad, a white TPO roof is not the same as getting a brand new roof.
Kyle, to what extent is this market impacting the cosmetic exclusions in certain policies? We've been talking about cosmetic exclusions for 10, 12, 13 years. Has that changed and become a harder thing to talk about in the same way that the general macro market has been impacted?
Great question. So cosmetic damage should not be covered unless it's your car. If your personal vehicle, if you get hail dings, your auto insurer will replace the hail dings. Your car still runs fine, it's a cosmetic damage on the hail dings. On roofs, hail, just because your roof got hailed on does not mean you need a new roof if it's cosmetic. And carriers start using this cosmetic endorsement almost like a hammer to keep from paying claims, but it shouldn't have changed anything. But what we're seeing is adjusters, who are the ones that come out and decide if it's a claim or not, are using it as a get out of jail free card.
That's precisely my point, right?
And
right.
so what we do to avoid that, there's just like there's good insurance agents, good real estate brokers, there's also good adjusters. And so with the type of policies we write, we're able to assign the adjuster to that policy if there's a claim or not. So that way I know when there's a hail claim that it's not going out to a big pool of, it could be any of these 100 adjusters and we're rolling the dice. I've pre-assigned that Grant, who I have a working relationship with, is going to go out and see the property. Now, I don't get any favors from Grant. I'm not able to sway coverage or not, but I know he sees claims the way I see claims. And I know the result I'm going to get when he goes to look at it. So when Grant goes look at a property and says needs a total new roof, it needs a new roof. He says this is not, then that's true. And I have confidence in our relationship that I can go to the owner and say, it hailed, this professional says it's not a total replacement, and you can feel good selling the property saying, yes, we have hail damage, but this person said it didn't need a new roof. I don't have a depreciated value roof, that I can still sell this for full price.
Well, Kyle, this has been a really informative discussion. We appreciate you coming in to talk with us about it. There's a lot that we've learned. Hopefully this is something that our market will be able to take in and into consideration when they're looking at strategic options. And clearly you go about your business in a way that is very reminiscent of how we try to approach things, which is advisory oriented, very thorough, very objective, and at times perhaps candid. So we would encourage everybody who's looking at this video right now to have that conversation with you personally, because it's a hot topic right now and we need to get in front of it. So thank you for coming in and doing this for us.
Yeah, well, thank you for having me.
Thank you.